In this video, we are going to find out whether or not Coca-Cola Company is currently a time where we should be selling and why. We're going to run through everything we usually do. We're going to take a look at the historical performances of the company, how well it's performing in terms of its revenue, its balance sheet. We're going to, as always, take a look at that dividend safety and some very key financial metrics. And as always, we're going to end the video with our stock valuation model, looking at that intrinsic value and finding if we did want to buy, what would we be looking at in terms of our acceptable buy price given our margin of safety. Now, before we jump straight into the video, I'm just going to mention that there is a Patreon that I have now created. If you're interested in getting to vote on YouTube what videos of what stocks is analyzed, Discord access with a community of like-minded individuals, and Patreon-only updates, as well as real-time notifications of my portfolio activity, then do go ahead and subscribe. Do check the pinned comment. Now, year-to-date, the Coca-Cola Company is down 3%, and the current yield is sitting bang on at 3%. Now, if you were to be a shareholder over the last 10 years for Coca-Cola, you would be up around 55%. In reality, for me, that is not that much growth. I wouldn't be looking for my stocks right now over the next 10 years to be growing by 55%. So for me, straight off the bat, 55% is not where I'm looking for in terms of my own portfolio. But let's see if there is an opportunity, or if we are shareholders, should we be considering putting our money elsewhere? Now, in terms of their revenue over the last 5 years, the Coca-Cola Company reported 34.3 billion in 2018. 2022, 43 billion. So I would say some nice growth over the last 5 years in terms of revenue. However, what we can see is due to the recession, the revenue did decrease from 37 to 33 billion. However, it did then pick up after in December 21 and 22. So I think that's a positive sign, even though even though the pandemic did happen, it did drop, but it did then pick up and continue to pick up. That is one positive sign of the company. Now, I always like to look and see if that also affects the bottom line, that net income. And what we can see in 2018, it reported 6.4 billion worth of net income. And in 2022, 5 years later, 9.5 billion. So whilst we do see this drop here relating to COVID, it did then pick up. So I would say that is a relatively positive sign in terms of the income statement and their revenues and bottom line. Now, looking at their balance sheet and looking how their cash compares to their total debt, we can see in 2018, the Coca-Cola Company had 9.1 billion worth of cash, and in their latest quarterly report is currently sitting at 12 billion. So nice growth there as well over the last 5 years. And in terms of their total debt, when we scroll down, we take a look here, their total debt went from around 44 billion to just under 44 billion in their latest report. So their total debt has remained relatively flat, and they have increased their total cash balance very slightly, but in the right direction. So it is a positive. Now, looking at the dividend safety, currently sitting at a score of 80, which is safe, and a market cap of 267 billion. Now, one thing to note with this company, they have been paying a dividend for the last 103 years without a reduction. Very, very strong when you're looking at companies. So over 100 years is a very good indicator. They also paid a dividend, an increased dividend over the last recession from 07 to 09, which is positive. If you are thinking we are heading into a recession or we are in one, then this is a positive sign. Recession sales, likewise, it was negative. However, it was above the average growth during the last recession, and it was negative return. However, this did beat the S&P 500's negative 55% return. Now, one thing with me, I want at least 4% in my dividends year-on-year increase, or salary or any income producing assets, as it means your purchasing power does not decrease. The US inflation rate over the last 40 years was 4%. If you are earning less than that, you are losing your money. Now, while we can see at least over the last 5 years, year-on-year, it basically met inflation. Over the last 20 years, it was 8%. So that is a positive sign for shareholders who have been holding the Coca-Cola Company for the last 20 years. You've been outperforming inflation. And as I mentioned, 103 years of paying a dividend without reduction and 60 years of consecutive dividend increases, making it a dividend king. Meaning, dividend king is where a company pays a dividend and increases year on year for a minimum of 50 years. So this is positive to see. Now, dividend yield theory states that a company is undervalued when that yield is sitting above that 5-year average. So the Coca-Cola Company is roughly in line with the 5-year average, therefore meaning it is reasonably valued. Now, as always, this does not mean we don't take what we see in this one model as gospel. We essentially look at a few different models and then we essentially conclude at the end. So once we look at our 4 valuation models here, we will then come to our conclusion. Forward PE, again, similar to the dividend yield theory, is essentially in line, which means that it is fairly valued. Again, this can be said the same for the sector PE comparison, in line roughly with that 21.4 consumer staples. We'll take a look at that when we look at our multiples valuation model. 52-week price range currently sitting in that mid to upper range of $61.44. And as always, if it's at the upper end, it's not overvalued. If it's at the low end, it's not undervalued. Just good to see for information purposes. Now, earnings payout is always susceptible to manipulation through their accounting, so it's not one that I look at closely, but I have it here just for those who like to see that, the investors. I always like to see below 60% as there's room to grow that dividend. Now, what we can see here is for the last 10 years, they've been fairly consistently just around that 70%, slightly above. So it's not that bad. I do prefer to see around 60%, but the fact that it's been very, very essentially consistent is a positive. Now, what I like to look at the free cash flow payout shows a slightly different picture from 2016 down to 2022. It's been above 80% other than 2021. And over the next 12 months, it's touching that 80% at 77%. So again, not something that I like to see, but it is below 100%. So it's not a massive red flag indicator, but it's something that I would keep an eye on the quarterly and annual reports to ensure it's not heading above 80%. But that 80% does mean to me that it will not be able to produce double-digit dividends, and it will likely be around these figures year on year. Now we move on to the earnings per share and free cash flow per share. Again, I like to see nice growth year on year. Unfortunately, we are not seeing that. Again, I prefer to look at the free cash flow, but if for those that like the EPS, $2.08 in 2013, $2.48 in 2022, there hasn't been a real growth over this period. And likewise with the free cash flow per share, the same can be mirrored. $1.80 in 2013, $2.20 in 2022. So again, no real growth that I like to see when investing in a company. And unfortunately, it looks the same here when we look at the sales growth. 3 to 7% is what I like to see for a steady company like Coca-Cola. Essentially, over the last 10 years, it looks like 7 years have had negative growth. And we can see that here with their total sales. It has been declining and has only started to increase. In fact, 10 years ago, they were making more sales than they were now. So that for me is a red flag indicator. And I would look very closely at how they're performing over the next few years to ensure it is back upwards trending as opposed to downward. Now, shares outstanding, relatively flat over the period. Not much to say. Coca-Cola don't tend to do cash buyback, so essentially they are not returning excess cash to their shareholders through buying back shares. They do obviously offer a dividend, but this is just to say there is no real value here. Return on invested capital, I like to see above 10%, and year on year they're doing that consistently, so that's at least one positive that management are allocating their capital well. Operating margin, another positive, above 16%, very nice to see. Free cash flow margin, above 7% other than 2017. 2022, 19%, and 2021, 24%. So that is positive to see. Net debt to earnings before interest, tax, depreciation, amortization, below 4. Essentially in 2022, it would take Coca-Cola 2.19 years to pay off all debt net of cash. So positive, no real issues for me in terms of their debt levels. And their net debt to capital below 0.65. 54% of their financing in 2022 was from debt as opposed to equity. So no real issues with regards to their debt. So I think overall there are a bit of a mixed bag from what we just went through. Some, I would say, maybe light red flags that you just need to be aware of as you look at their reports year on year to ensure it's upward trending for certain financial metrics. Now jumping straight into the stock analysis, smash the like button if you do enjoy that content, and do smash that subscribe if you want to see more content. So the stock, Coca-Cola, the earnings per share at $2.27. The growth rate expected by analyst estimates in the future is 12, and we've inputted the current yield on AAA corporate bonds. Gives an intrinsic value of $40.55, which we can see here is significantly below the current trading price. We then move on to the multiples valuation model, companies in a similar industry and size, PepsiCo, Monster Beverage, and Dr. Pepper. So we have the stock price, the earnings per share, and this gives us the PE multiple. Now, we get to the average PE. We multiply by the earnings per share to get a multiples valuation of $92 for Coke. So some significant upside according to the multiple valuation, although some could argue that some of these, such as Monster Beverage, are at a higher PE, which means this should be slightly lower. Dividend discount model. Now, over the last 5 years, we've inputted the yearly dividends. We can see that growth rate year on year with an average growth rate of 3.36%. Now, forward looking, I've gone slightly more optimistic. I like to think that Coke will start to be able to increase by around 5% as they have nearly done over the last couple of years. So I've gone with a more positive forward looking at 5%, and this gives a DDM price of $55.20. Again, that's right at that 52-week low and showing quite a lot of downside to the current trading price. Now we move on to the final model, the discounted cash flow model, where we've inputted the free cash flow year on year, and we can see the growth rate year on year. So overall, we can see the average growth rate has been 4%, and over the last year, there was quite a significant drop in that free cash flow. Analysts, however, are estimating 12% moving forward, so they are expecting Coke to start increasing that free cash flow. And the future free cash flow we can see here. Once we've used our discounted rate, we get the present value of these future free cash flows, as well as that terminal value, which we sum together alongside the cash, subtract the total debt, and arrive at our equity value. Once we've divided that by the shares outstanding, it gets to our DCF price of $67.16, slightly above that 52-week high. Now, the intrinsic value is essentially the average of these 4 models that we've just run through. So according to the models that we've gone through, the intrinsic value is sitting at around $63.75, slightly higher than the current trading price, but essentially there and thereabouts. In terms of the current price, we can see here, typically I'd be looking for a margin of safety for a strong company with a wide moat at around 10%. So if you were looking for a 10% margin of safety, you would be looking for a buy price around $57.38, slightly higher than that 52-week low. Now, some people would argue they want a higher margin of safety, especially in this industry. So you'd be looking at around a $51 entry, which is a little bit below that 52-week low. Now, as always, let me know your thoughts. Let me know your thoughts in the comments. But let's head on to what Wall Street forecast. They believe that there is some upside to that current trading price and believe over the next 12 months it will hit just under $70, which is a little bit higher than that 52-week high. As always, let me know your thoughts in the comments. Let me know whether you're a shareholder, whether you're buying, whether you're considering to sell. And just to mention, if you do want to get that Patreon and join me in the Discord with our community, then do go ahead. I will add that link into the comments. As always, have a lovely day and catch you on the next one. Thank you and goodbye.